Could the U.S. be soon plunging into an economic depression? With the entire world facing inflation, could history repeat itself with another global economic crisis? Let's find out whether the U.S. economic bubble is bursting or whether there is even a bubble at all. Now, before we discuss the state of the U.S. economy, let's first discuss what a bubble is. In an economic context, a bubble generally refers to a situation in which a stock, a financial asset, a certain sector, or a market is priced at a level at a margin that is much higher than its intrinsic value. Since these price levels are set by speculative demand rather than actual worth, the bubble keeps on growing till it gradually and inevitably pops. This often causes people to panic sell, which drastically reduces the prices. Bubbles often lead to dramatic crashes in the markets. There are 5 stages to a bubble. The first stage is displacement. A displacement is said to happen when there is an expansion of economic activity in certain sectors or areas, which also leads to a contraction of economic activity in other areas. A displacement happens when investors get lured into new changes such as innovative new technology or low borrowing costs. Next is the boom. After the displacement, the prices slowly start to rise and then keep increasing at a higher rate as more people start to invest. A large number of people invest in order to avoid missing out. The next phase is euphoria. At this phase, people generally stop caring about cautions as the price of the asset keeps increasing to sky-high levels. The prices will be very high, yet there would be people to buy them along with justifications. For example, during the peak of the dot-com bubble in 2000, the value of all technology stocks on the Nasdaq was higher than the GDP of most nations. Next, profit-taking. In this phase, the institutional investors and other big players start to realize that the bubble will pop soon, and thus start selling their holdings and making profit. But estimating the exact time when a bubble is due to collapse can be a difficult exercise. Lastly, panic. Once a bubble is popped, it can't be inflated. During this stage, the price of the assets nosedive. The investors are now willing to liquidate their holdings as soon as possible. In case you weren't familiar, this isn't the first time that the U.S. faced a bubble. The last prominent bubble was the financial crisis of 2007 through 2008, which spread across the entire world, making it a global financial crisis. In the early 2000s, the interest rates in the USA were reduced from 6.5% to 1%. This was done as a response to the dot-com bubble burst and the 9/11 attacks. Since the interest rates were so low, people began to take more loans to buy homes. Almost anyone could get approval for a loan, even when they couldn't afford it. From mortgage approvals to lines of credit, everyone bought things on credit. Thus, people choose to buy on credit rather than use actual funds. Inflation grew along with unemployment. The financial institutions give credit based on the houses. Then homes began to lose value. That is, the bubble popped. People started defaulting on their home mortgage loans. Since their homes were worth less now, they no longer felt the need to repay their loans, which now became very expensive. Banks were unable to collect their debts. This crashed the economy and 25 banks went under in the United States. This economic crash led to a global economic crisis. Jeremy Grantham, the legendary British investor and co-founder and chief investment strategist of Grantham, Mayo and Van Otterloo, or GMO, says that the U.S. economy is at its last stage of a super bubble. Grantham built his investing reputation over the course of his career by identifying speculative asset bubbles as they were unfolding. He is said to have identified the Japanese asset price bubble in the 1980s, the dot-com bubble of the 1990s, and the housing bubble of the 2000s. In his recent article, or warning as some would say, he says that the U.S. stock market remains very expensive and the inflation is hurtful. He adds that with issues such as COVID in China, war in Europe, food and energy crises, record fiscal tightening, and more, the picture could be far worse than anticipated. First, the bubble forms. Second, a setback occurs, for instance, the Russia-Ukraine war, which leads to the valuations to take a half step back. Then there is the bear market rally. Fourth and finally, fundamentals deteriorate and the markets decline to a low. He then proceeds to draw parallels to the previous bursting of bubbles, that is, from the November low in 1929 to the April 1930 high, the market rallied 46%, a 55% recovery of the loss from the peak. In 1973, the summer rally after the initial decline recovered 59% of the S&P 500's total loss from the high. In 2000, the Nasdaq, which had been the main event of the tech bubble, recovered 60% of its initial losses in just 2 months. In 2022, at the intraday peak on August 16th, the S&P had made back 58% of its losses since its June low. Thus, we could say that the current event so far is looking eerily similar to these other historic super bubbles. So, what exactly is the economic condition of the United States? Inflation is at its highest level in the U.S. since 1982. Moreover, the moratorium that was introduced during the pandemic on student loan payments, collections, and interest ended earlier this year. The student loans in the U.S. amount to nearly $1.75 trillion. A surprising fact, since January 2020, the U.S. has printed nearly 80% of all U.S. dollars in existence. Comparing indices, the S&P 500 is supposed to be stable, but it is at 3,583 points presently compared to 4,796 at the beginning of the year. It was at 2,305 points in March 2020 after a crash due to the pandemic saw it collapse from 3,380 points a month earlier. A recent survey by Bright Pearl states that about 1/3 of U.S. retailers are 8 weeks away from going bust due to supply chain issues. Moreover, there are many reliable economic indicators that are showing warning signs that the U.S. economy could be in trouble. Inverted yield curves have been a strong indicator of economic recession. In fact, the U.S. economy has faced a recession within 18 months of a yield curve inversion for about 2 out of 3 times. The current yield curve inversion is the deepest since 2007, which also appears to be the year before the global financial crisis. This brings the U.S. Federal Reserve and the government into question. Is the U.S. government doing anything to prevent this economic disaster? The Federal Reserve is starting to accept that the inflation is not temporary and that it has long-term implications. The Federal Reserve hopes to reduce inflation by slowing down the economy. Increasing the interest rate, that is, making borrowing more expensive for U.S. companies to borrow money to invest in innovation and growth, will reduce the inflation. Increasing other rates, such as credit card, mortgage, auto loan, and other interest rates, also reduce the disposable income Americans have to spend. However, there are still a myriad of issues that the U.S. economy has to deal with. The Russia-Ukraine war has led to disruption of imports from Ukraine and Russia. According to the U.S. Department of Agriculture, Russian and Ukrainian wheat exports are about 1/4 of the global total. Roughly 20% of global exports of corn and other coarse grains, and about 80% of exports of sunflower oil will come from Russia and Ukraine. And most of us already know that Russia also happens to be one of the world's largest oil producers and energy exporters. The changes in crude oil prices due to the war represent about 40% of the changes in the cost of fuel at the pump in the United States. Russia also happens to be the world's largest exporter of fertilizer. Then there is the problem of the Chinese economy, which is also set to crash soon, facing a similar state of that as the U.S. faced in 2007 through 2008. The real estate sector involves around 30% of the Chinese GDP, and China is the second largest economy following the United States. Should you be worried and try to liquidate your assets as soon as possible? During a bubble, there is a possibility that the assets could plateau for a long enough time, which would allow wages and the real economy to catch up. Since the economic effects of the bubble would be highly detrimental, the Federal Reserve will delay the pop as much as possible. However, this could make the situation much worse if the bubble actually pops. Moreover, inflation and recession is fairly common in the U.S. There has been about one U.S. recession for every 5 years since World War II. There have also been more instances where the economy has shown signs of a bubble and yet was able to recover back to its previous state a while after the fall. The interesting part of a bubble is that no one can predict when it will pop, but you can surely subscribe to this channel to become updated and informed.